A very good morning to all of you. Type in yes into the chat box if you can see my screen and hear my voice. So just give me a confirmation. And once I have the confirmation, we'll start with today's session. Right, so into the chat box, type yes if you can see my screen and you can hear my voice. And another thing, okay, first let me wait for the confirmation, then I'll add something. So I'm just waiting for some replies to confirm that things are working fine. Perfect. Great. Thank you so much. Now, one thing which I'll add is that I can see many of you are watching this stream in a resolution which is a little less. So in the settings where you are watching this stream, so click on that settings icon and you can select the stream settings to be 720p. That way the text and everything would be much more clear, right? Otherwise, if your streaming option is selected to 360p or 480 or maybe 240p, then what will happen is the text might not be very clear to you. So just make sure you have selected 720p to have the best experience, so that everything which you see on the screen is clear enough for you to read and understand. Perfect. So what we'll be doing in today's session is we will be understanding what demand and supply is all about, right? Because I've done a lot of sessions, but I've never gone in depth about what is demand, what is supply when it comes to these YouTube live sessions. So I thought, why not to do a session where we try to have a better understanding that what the demand and supply is, and what kind of methodology do we teach when it comes to doing the analysis which is based on demand and supply. So what we'll do is we'll start with the basics, right? We'll try to understand how people they trade, what are the mistakes they make, and how demand and supply can help us plan trades in even in a better way. So during the session, if you have any questions, queries, don't hesitate, feel free to put it in the chat box, and I'll definitely be helping you with your questions and queries as well. So let's continue. So when it comes to doing trading, right? So basically trading, whenever people they want to be a buyer or maybe be a seller, uh, they basically refer to two different styles of analysis. One of them is called as your fundamental analysis, and the other one is called as your technical analysis. Now what happens in fundamental analysis is that people they look at the overall health of the business, right? So the way they look at the health of the business is maybe by looking at the earnings, maybe by looking at their management, maybe by understanding how their orders have been or how their earnings have been quarter after quarter, and based on that they make their decision whether this company is a strong company or whether this company is a weak company, right? And whatever their analysis based on fundamentals tell them, it can also be something which is much more advanced, where people they look at the balance sheet, PE ratios, n number of things, and based on that they make their decisions. Now, the second stream of people who trade is by using something which is called as technical analysis. Now, in technical analysis, what happens is that people are least bothered about how the management is or how the earnings have been for that company quarter after quarter, or how their order books they look like, right? They are least interested in that. What they do is they just look at the chart of that company, and that chart basically shows you how the stock has been moving in the past, and looking at that past characteristics, right? They apply some mathematical calculations, right? They apply some indicators, right, which are basically those mathematical calculations. They apply some chart patterns, maybe a number of things, and using that they make their decisions whether they want to be a buyer or they want to be a seller, or maybe they want to stay away from that script, right? So that is what happens. So these are basically the two primary ways which people they use. Some people might be purely fundamental analysts, some people might be purely technical analyst, some might be using a mix of both, right? So that is how people they decide whether they want to be a buyer or they want to be a seller based on any of these two methodologies, which is your trading analysis methodologies. Now, if you want to break it down to a very simplified version, what I'll say is fundamentally analysis broadly teaches you that if you identify a company which is a fundamentally strong company, so if the company is strong, we are expecting its prices to rise. And because we are expecting the prices to rise, what you should be doing is you should always be buying such companies. Okay, again, I'll add, I can see some people have joined in a little late. So in case you can't see the text very, very clear, the reason for that is you would have selected your stream option to be a little less when it comes to uh, the resolution. So just make sure you have selected 720p as your stream resolution so that the text is clear to you. Now, similarly, when you are doing that fundamental analysis, and if you see that the company you're analyzing uh, seems to be a weak company, right? Now, that is a company where we would not like to, buy it. If you're already holding it, now we are expecting the prices to move down. So that is where probably you might start looking for selling opportunities on that company, right? And you might be maybe closing a position or maybe even taking short positions, right? So that is what a fundamental analysis broadly talks about, that if you have a strong company, it's a good bet to be a buyer. If it is a weak company, it's better to stay away or maybe to sell it. And similarly, when it comes to technical analysis, broadly technical analysis teaches you, the fact is, if you pick any trading book, the very first thing it teaches you is trend is your friend, right? That is what something you would have heard from a lot of people who do technical analysis, and maybe also read in a lot of trading books, also on the internet, on different trading websites, that trend is your friend, which basically implies that if you are in an uptrend, you should always be looking for buying opportunities, and if you're in a downtrend, you should always be looking for selling opportunities, right? So that is what broadly fundamental and technical analysis they teach you. Now let's take a case. Let's imagine we have a stock which is trading at 100 rupees. And what happens is this stock starts moving up from 100 to 110, then to 120, then to 130. So if you look at this move to the upside, now if I start analyzing this stock as a fundamental analyst, right, this might be a strong company because that is what I've seen, that it has been going consistently higher and higher. And the only reason for this could be maybe, they have order books which looks really, really nice. Maybe their earnings quarter after quarter have been really, really nice, right? So when it comes to fundamental analysis, probability is high that this company would prove to be a strong company for us, where we would like to be a buyer. Similarly, if you talk about technical analysis, we know this is an uptrend. In an uptrend, we would again like to be a buyer, right? So that is what broadly fundamental and technical analysis they teach you. Similarly, if that script has been moving down from 100, it went to 90, then to 80, then to 70. Now, this would be a downtrend. So if you are somebody who follows technical analysis, because you're in a downtrend, you will be looking for selling opportunities. Similarly, if you talk about that company fundamentally, the only possible reason why it is moving down is maybe even fundamentally it's not doing really good. Maybe they don't have good order books. Maybe their earnings quarter after quarter were not really, really nice, because of which the stock has just been declining, right? So in such case, we would be more interested in being a seller and less interested in being a buyer, right? So that is what broadly your fundamental and technical analysis is teaching you. So when people, they look at the chart and they see that the prices have been moving consistently up, for them it's an uptrend, they buy. It's a fundamentally strong company, they buy. And the third reason why also people they buy is your reason is greed, right? Because of that greed, because one recent example which I can give you for that greed is your cryptocurrencies, right? You can see the way the cryptocurrencies just started moving up. People who never even heard about what Bitcoin is or what those cryptocurrencies is, now everyone is trying to invest into those assets. Why? Because of that emotion of greed, right? They feel that they are the only person who are getting left out, and rest of the world is making a lot of money and minting a lot of cash on those assets. And because I'm the only person getting left out, let me also get into it, right? So that is where that emotion of greed also comes into the picture. Similarly, when you see, and because of that uptrend or fundamentally strong company, absolutely yes. So can you hear me? Right. So Raj, you asked if did the webinar start. So can you hear my? Okay, let me just check. Everyone, can you hear my voice and can you see the screen? I just let me know in the chat box, because the question which I got is did the webinar start? So I am a little confused. If you guys can see the screen, right? To me, seems like everything is right. So to me, seems like everything is working fine. right? So just put it in the chat box if any one of you is facing any challenge, right? You should be able to see my screen and you should also be able to hear my voice, right? So just to reconfirm. Perfect. So Nathan, that's a very interesting question which you asked. That a lot of people who were technical analysts first, and then they started losing, and then they became fundamental analysts, and they both say that you should not be trading, right? So I'll be giving you the reason behind it, why they tell you this, and this is. This session will definitely help you understand why they say that, right? So I'll definitely help you with that. So don't worry. By the end of this session, you will know why most of the people they tell you not to do it, right? So not to worry. Great. So this is what people do, right? Because it's an uptrend, they buy. Because fundamentally strong, they buy. Because of that emotion of greed, they buy, right? Similarly, if a script has been moving down, right? So now it is downtrend, they start selling. Now it is a fundamentally weak company, they are selling. And now the emotion is also that emotion of fear, right? And what will happen is, because of emotion of fear, maybe you were holding a stock which was at 160, it has gone down to 40. Now you will be scared and you will be selling like anything, right? Because you don't want to lose that 40 rupees as well, and you'll be selling it. So this is what the majority of the people they do, right? Which we call as the retailers. Because that is what they have learned, and because that is what they have learned, these are the actions which they take. Now let's go a little off topic, right? From stocks, I'm just moving to, let's say, a cell phone, right? So I'm just going off topic for a minute to get to a concept which we'll be discussing as we move ahead with this session. Now let's imagine, there is some phone which you really, really like, right? And let's imagine that your favorite phone is costed at around 70,000 rupees, right? And now what happens is that the phone which was for 70,000 rupees, I offer you that phone to you. I offer that phone to you for 65, right? So if I offer this phone which has an MRP of 70,000 for 65, for maybe any reason, right? Maybe because I bought it and I didn't like it and I want to sell off my phone and I want to sell it off for 65. So how many of you would be interested in buying that 70,000 phone for 65? Just put it in the chat box if you would be interested. You're getting that 75,000 phone for 65,000 rupees. And the reason is, I bought this phone, I didn't like it. Now I want to sell it off. And I know, because now I'm selling it off. Maybe, I just used it for a day and I didn't like it now. So would anyone be interested in buying it at 65? Just say yes in the chat box if you would be interested. Right, so I'll wait, because the problem is the audios and the chat, it's always a little lagging in these sessions, the YouTube, so it will take some time for me to get the replies from you, right? So I'm waiting for your replies. If you would be interested in buying this phone for 65, which has an MRP of 70,000, would you like to buy it? That is what my question is. Okay, so Sahil, what price would you like to buy it for? If not 65, what is the price you're looking for? And Gagandeep, right? So it's your favorite phone. Same question. It's your favorite phone. It's just that now you're getting at a cheaper price. Right? So that is what my question is. If it's not just about phone. It be that anything, right? Let's imagine you like some car, or you like some bike, or maybe you like some other gadget, right? And now you're getting that at a discounted price, right? Now, if you look at these sales which happens, right? The reason people they rush to these sales is because they're getting some stuff which was at an expensive price at a cheaper price as of now. So let's imagine maybe you don't like the price, which is 65. Let's push it down, right? Because I don't have willing buyers who are interested in buying at 65, maybe at 60. Would you like to buy it? Now you're getting almost over 10% discount on this phone, right? So would you like to buy? Okay, so Sahil, you said 60. I already gave you the price, which is 60, right? So can you see, you would be happy buying at 60 now because you know that you're getting that phone for a cheaper price. But what if I offer it for 55, right? Now, would anyone else be interested at 55 buying this phone? Right, I'm very sure many of you might be interested, right? Because I know the chat is a little lagging. So what I'll do is I'll just move ahead. But what I'm basically talking about here is if the phone starts getting cheaper and cheaper, and if I offer the same phone which was for 70,000 rupees to you for 50,000 rupees, I'm very sure many of you would be interested in buying it. And the reason you would be interested in buying it is because now you're getting that asset at a discounted price, right? If you now talk about your real life situations, that is what happens every day. Whenever we get something at discount, we are always willing to buy it because we know we are getting it at a cheaper price, right? So whenever the prices they go cheap, what do? We always love to buy at cheaper prices, right? But what do we do when we follow technical analysis and we follow fundamental analysis? In technical analysis, when we see that downtrend, we are not interested in buying, we start selling, because that is what we have been taught, that in a downtrend you should always be selling. And whenever the prices are moving down for a stock, we feel that this is a company, maybe it's a weak company, and because it is a weak company, I should be selling. And on top of that, even your emotion of fear makes you sell that stuff, right? So who asked that question? Nitin, right? So Nitin, you said, some people, they said should not be trading, right? Be that technicals, be that fundamentals. And this is the reason, because both fundamentals and technicals are designed backwards, right? Something which we logically never do in real life. In real life, whenever we get something cheap, we always buy it. But here we are defying that logic, right? We are going against that logic, and now we are selling something at a cheaper price just because that is what we have been taught. And that's the reason people, they always tell you not to follow technicals and not to follow fundamentals, and it's better not to trade, because the education in itself is designed backwards, right? They make people do things which they should not be doing. And that is where, no matter how good you get with your fundamental analysis, no matter how good you get with your technical analysis, you will always make that basic mistake, which is selling at cheaper prices. Similarly, if the prices they start going up to 75, right? Now let's imagine the same phone 70,000, but I say, okay, I will give you this phone for 75. I'm very sure nobody would be interested in buying. Right? Maybe you don't like the price, you want a better price. I give you 80,000. Nobody will buy. I give you 85,000. Trust me, nobody would be happy buying, right? So irrespective how high the prices, I keep taking these prices, none of you would be interested in buying at an expensive price. The reason is because we always want to buy cheap. But now when it comes to what happens when the prices are getting expensive and we are following fundamental analysis or technical analysis, for us, this becomes as an uptrend. And now we start getting more and more uh, interested in buying that stock, because that is what we have learned, that when the prices are moving up, it's an uptrend for us, we should always be buying. It's a strong company, we should always be buying. So again, can you see that logic, which is at cheap we should always be buying, at expensive we should always be selling, goes out of the window when it comes to trading the financial markets, because the education in the financial markets have been designed backwards, right? So Raj, you said, are you watching webinar? So Raj, is that question for me or was it for someone else? Because I'm getting a little confused. Seems like some of you might be facing some challenges. Should not be happening. So if you are facing challenges with the text, right? So the reason for that could be maybe you're watching the stream with the resolution which is a little lower. So make sure you have selected the resolution as 720p, which is where the text would be crystal clear, right? So that could be the only issue. So that is what probably I can infer from your question. Maybe a problem with the text. Perfect. So let's get back. So again, the problem which we discussed here is that fundamentals and technicals, both of them are designed backwards, right? We make these same mistakes over and over again. And that is when we start feeling that, this does not work, right? Because it's not that this does not work. It's just that what we have learned is designed backwards, and we keep making that same fundamental mistake over and over again, over and over again. We always sell cheap and we always buy expensive. And I'm very sure many of you would have experienced this, that the stock was moving higher and higher and higher, irrespective whether you followed fundamental analysis, technical analysis, or maybe the greed. As soon as you buy that stock, what happens next? The stock starts going down. And why did the stocks started moving down? Because you were very happy buying at those expensive prices. But people who understand that expensive prices you should not be buying, you should be selling, now they will start selling at those expensive prices because we already have willing buyers at those expensive price, and now they will love to sell huge quantities. And what will happen is, as soon as they start selling, we have more supply in the market and prices would start moving down. And then you'll be thinking, why does it always happen to me that as soon as I buy, after me buying, the stock always goes down? And I'm very sure many of you would have experienced it, irrespective whether you followed fundamentals, technicals, greed, tips, or be that anything. And you would have also experienced this, that as soon as you sell, right, which could be because of downtrend, fundamentally weak company, or maybe your emotion of fear, but as soon as you sell, what happens is the stock starts going down. And the reason for that is that 70,000 phone was available for 50,000 now, and somebody was very happy buying at those cheap prices. And because they started buying at those cheap prices, we started getting that demand which started coming into the market, which made the prices to move up, right? So this is the reason why the question which I got from Nitin, he said many investors like Vijay Media, they were traders first, means they were technical analysts, and after losing capital they become fundamental analyst. And they both say that you should not be trading, right? The reason they say you should not be trading is simply because of this, because the education is designed backwards. It's almost like if I start teaching a 1-year-old child, I show him let's say I show him black color, but I teach him this is not black, this is called as red. So what will happen is, when that kid will grow up, he will always call black as red, right? And that is what we have been trained for, right? We have been trained with the incorrect logic, incorrect approach, and that is what we feel is the right way to trade. We keep doing it, we try to improve it, we try to learn more about it, but when the core concept is designed backwards compared to the logical thing which we should be doing, you would always be getting stuck in such situations, right? And that's where people, they start saying it's better to avoid and not to trade, because the education is basically backwards. Now, the next thing is, what is the correct way to trade? So even before we start learning what is the correct way to trade, first we need to understand, why do prices move, right? Because if we know why prices they move, probably we can try to understand a methodology which can give us that edge, where we are not making that mistakes which we just discussed, and we are planning in a better way and planning our trades in a more mechanical and systematic way, which logically also makes sense to us. So let's understand why prices they move. Now let's imagine we have a stock which is ABC, and that stock is trading at 250 rupees. Now for any transactions to happen, we need to have buyers and we need to have sellers. So let's assume that we have 4 buyers and each of them are willing to buy 100 shares each, which means at 250 rupees, we have a quantity which is 400 shares to be bought. Now, for these people to buy at that 250 rupees, there also needs to be seller at that same price, right? Because the buyer and seller has to be at the same price for a transaction to happen. If the buyer and sellers are not at the same price, a transaction will never happen. So let's assume that 2 sellers, they step in and they say, okay, we are happy selling 50 shares each at 250 rupees. Now, what will happen is that these 2 sellers will be absorbed by 1 buyer, right? Because they were selling 50 shares each, so 50, 50, 100 shares. And this guy wanted to buy 100 shares. So one of the guy got his fill. And now we are still left with 300 shares. Now, if you think now logically about it, people who wanted to sell at 250 have already sold, right? Where will be the next buyer? Where will be the next seller? Will the next seller be at 250? Or will the next seller will always be at a price which is expensive than 250, right? So I'll wait for a few seconds to get your answers. So my question again is, when people who wanted to sell at 250 rupees have already sold, right? Where will be the next seller? The next seller will be at a more expensive price, or will the next seller be at a cheaper price, right? That's my question. So I'll wait for a few seconds for you people to reply. I'll wait for your replies in the chat box. And let's see, what do you people think? Right, so I'm still waiting because I know there is a lag, so you have to bear with me. I can't do anything about that lag. That is what happens. So where will be the next seller? That is what the question is. Expensive price than 250 or cheaper price than 250? Expensive, right? Expensive, right? So Nilesh, you said cheaper, not cheaper, because whenever you want to sell, would you like to sell anything at a cheaper price? No, you would always like to sell at an expensive price, right? So yes, that can be 250 rupees, that can be 5 paise, 250 rupees, 5 paise, 10 paise, maybe 251. It can be any price, but this is for sure that the next seller would always be at an expensive price and not a cheaper price, right? Yes, can also be 300, but right, but the fact is that the next seller will always be at an expensive price. So now, because the next seller will be at an expensive price, what will happen is that these people who want to buy now will be forced to buy at an expensive price, because nobody is selling at 250. So if they still want to buy, they will have to increase their price to go to the next seller. That next seller can be at 250, 50 paise, can be at 251, can be at 252, can be at any price, right? We don't know at what price that next seller would be. But for the next transaction to happen, somebody will have to buy at an expensive price, and only then the next transaction will happen. And if that somebody buys at an expensive price, right, and if somebody okay, good to know. And I don't know if you know about me. So you, like you said, you're an OTA student, you just joined recently. uh, just to give you my background, I was also an instructor with Online Trading Academy. I was an instructor with them from 2012 to 2017, right? So that's a small little brief about my background, that yes, I also was an instructor. I was an instructor with them. Now I just started with my own venture, right? So this is what will happen. You have buyers, you don't have sellers, and because now you don't have sellers, the sellers will be at expensive price, so the buyers would be forced to buy at an expensive price, which will result in prices moving up, right? So that is what we were discussing. Why do price move? So the reason the prices the move is because one of the two forces, either the buyers or the sellers, at a specific price becomes zero. And when it becomes zero, and like in this example, the sellers, they became zero, and because they became zero, the buyers were forced to buy it at an expensive price. So the origin of motion or change in price is an equation where one of the two competing forces, which is either the buyers or the sellers, they become zero at a specific price, right? And that is what happened here, because of which prices they moved up. Similarly, if you take the opposite example, let's imagine at 250, we have four people who are willing to sell 100 shares each, which means we have 400 shares to be sold at 250 rupees. Now, to sell, you also need buyers, right? And let's imagine two buyers, they step in and they say, okay, we are happy buying 50 shares each at 250 rupees. Again, the same thing will happen, that these two buyers will get absorbed because of one seller, right? And now we have willing sellers at 250, but we don't have any buyers. Just give me a second, please. And we know now the buyers will always be at a cheaper price, not at an expensive price, right? Because if I want to buy something, let's say if I go to the market and if the shopkeeper tells me, okay, whatever you want to buy is 250, I would always bargain, right? I'll say, okay, I don't want to pay 250, I want to pay, let's say 245, or I want to pay 240 or maybe 230, right? Because we always want to buy at a cheaper price. So similarly here in the market, the next buyer would always be at a cheaper price, right? Which means if the next transaction has to happen, the sellers will be forced to sell at a cheaper price, because if they don't sell at a cheaper price, no transaction is going to happen, right? Which is where if they start selling at a cheaper price, you will see that prices will start moving down, right? So now that we understand why prices move, right? Prices, they always move because of that imbalance between your buyers and sellers. When one of those two forces becomes zero, prices, they move. If the buyers, they become zero, the price will go down. If the sellers, they become zero, prices will move up, right? So now that is something which we have understood with from this example. Therefore, uh, a price level where willing demand exceeds willing supply, that is where prices, they move up, and prices, they always move lower at a price level where willing supply exceeds willing demand, right? So at a price level where we have more demand, prices will always move up. At a price level where we have more supply, prices will always move down. So now that is the foundation, how we try to identify our demand areas and supply areas, right? So now using this, because we know logically price always moves up because of demand and price always moves down because of supply, we apply the same logic to the charts, And now by applying it to the charts, we learn how to identify these area of supply and demand for us. Just give me 1 second again. So let's look at this example. Let's imagine that we are looking at some script, any script A, B, C, X, Y, Z, be that anything, and what is happening is that prices are moving within a range as of now, right? So the only reason for prices to move within a range, right, would be, do we have imbalance or do we have equilibrium, right? So do we have, because we just discussed that prices, they only move when we have imbalance. When they are moving within a range, which probably is telling us that we have both buyers and sellers, and transactions are happening between those buyers and sellers, which is showing us that equilibrium kind of phase, that prices are moving within a range. Now what happened is that after some time, all of a sudden we had a very nice strong move to the downside, right? So can you see from that equilibrium phase, we saw this imbalance, because of which prices, they came down and crashed like anything, right? So my question to all of you is, why did the price decline, right? Depending upon what we just discussed some time back, that prices, they only move because of demand and supply. What is the reason for this decline? Is it more demand or is it more supply? Right, so again, I'll wait for a few seconds for your answers. So the reason behind this decline can be what? Is it demand or is it supply? Okay, I'll wait for your replies, right? So what could be the reason for this decline in price? Demand or supply? More supply, perfect. Now the next question which I'll ask is, can any one of you give me any other reason other than supply? Right? Any other reason other than supply because of which prices would have moved down? Right? So again, Nilesh, we just talked about it. Whenever prices, they move up, that is because of demand. If the prices, they move down, it has to be supply, right? So up always has to be because of demand, down has to be because of supply. Perfect. Okay, so my question, next question was, can it be any other reason other than supply for prices to move down? Other than supply, can it be any other reason for prices to move down? Right? If you can find some reason, if you can give me some reason, put that. Big sellers, okay, for getting good price. All right. So like you said, technical trader, big sellers, right? If again we have big sellers again basically means more supply, right? Would you agree to that? Right, now if you say maybe bad news again means people started selling because of bad news, which will again boil down to more supply, right? If you say it was some selling tips, right, again selling tips basically means that people started selling and it has to be more supply. So no matter what reason we try to identify, everything will boil down to it has to be more supply, because of which prices, they started moving down. Now after this move to the downside, so okay, let's recap this. Because we said that the origin of any move in price is where supply and demand are out of balance, we know that this declined from this area, right? So this imbalance which got created has to be more supply, right? Similarly, after, and because now we know that this has to be supply, what we do is we wrap that area in two horizontal lines, and this is what we call as our supply zone. So in a way, the chart is telling me that this is where supply zone can be on this script, because we saw prices, they moved up, then we had this period of pause, and prices, they declined, which is where this area got converted into an imbalance, and that imbalance was supply. And we mark that area in two horizontal lines and we call it as our supply zone, right? So this kind of a pattern for supply, we call it as a rally based drop, right? So that's the pattern of rally based drop. Similarly, after this decline in price, again prices, they stopped moving down. Now what is the only reason for prices to stop moving down? Here you can see came down and now stopped. So this is basically telling us that yes, we had more supply, but now we had enough demand to counter that supply, because of which prices, they stopped moving down. And then what happened? Prices just kept trading in that range for some time, and after some time again we had this really nice big move to the upside, which means that equilibrium which was created after this move to the downside again got converted into an imbalance, and now this imbalance started pushing the price higher and higher. Again, if I ask you this question, why did the price rise? We know that the origin of any move in price is where supply and demand are out of balance. So this out of balance, this area where that imbalance was created would be termed as demand, because that is where prices they started moving up. So again, that area where that imbalance got created, we wrap it into horizontal lines, and this is what we call as our demand zone, right? So what we did is looking at the price action, right? So can you see we looked at the price action, how the prices were flowing, and looking at that. Okay, so how to Nifty's all-time highs? How can we find? Don't worry. So once you learn the methodology, the complete methodology, irrespective whether the stocks are making all-time highs or all-time lows, we have rules for everything, and we apply those rules. Now, just to make it very, very simplified, for a stock making all-time highs, we always look for buying opportunities, right? So that is what we do. I'll show you some examples as well as we move ahead. You will see it doesn't make any difference to us, right? So because we have rules for everything. So again, our methodology is very, very mechanical, no emotions involved, rules for each and every step which we will be doing when we do our analysis for these stocks. Now, this kind of a pattern is what we call as a pattern of demand. This is basically called as a drop based rally, right? It's a drop, we have this period of basing, and then we had a rally, that is called as your demand. So by looking at the price action, we were able to identify where is the supply zone on the chart, and we were also able to identify where is the demand zone on the chart, right? Now that is the basics, right? That is how we start identifying demand areas and supply areas in our methodology. And once we have identified the demand areas and supply areas, now let's think about who's on the other side. Now I have identified a supply zone. So now I know supply zone is an area where supply exceeded demand. So when the prices are coming back to this supply, what are we expecting? We are expecting that because of that supply, prices can move down, right? This is what we are expecting, that from here prices can move down. But now if you think about who is buying here, the person who will be buying here is a person, just give me a second, who based on technical analysis would feel it is an uptrend, and now he would be buying at that expensive price. Based on fundamental analysis, for him this might be a strong company, he'll again be buying at that expensive price. Or this might be a person who is now, based on the emotion of greed, is again buying and again would be making that novice mistake. And that mistake is that he is buying something at an expensive price. Mistake number one, right? Because of that uptrend, because of that fundamentally strong company, and that would be that novice. Similarly, if the prices they move down, and when the prices they go down, the person who would be selling at this price would again be a person who is selling in a downtrend, or maybe selling because of fundamentally weak stock, or maybe even because of the emotion of fears. But can you see now that person is selling at a cheaper price? So if somebody was buying at an expensive price, we should be selling to them. And if somebody is now selling at a cheaper price, we should be buying from them. And that is what we do, and that is what we look for when it comes to how to identify our trading opportunities. Once we have identified our supply zones and demand zones, we look for those two key novice mistakes which the novices they always make. Mistake number one, they will always buy after a rally in price. And now we know the reasons why they always buy after a rally in price: because of fundamental analysis, because of technical analysis, and because of greed. So whenever we see that prices are in a supply area, means now somebody is also buying here after a rally in price, we should be selling to that person. Why? Because we are anticipating that because of supply, now the prices can go down. So the two mistakes are they always buy after a rally in price, and not just buying anywhere. Now they are also buying in an area where the chart has proven to us that in the past supply exceeded demand, right? And when we see somebody making that mistake, our action would be to trade against that novice buyer. Because he's buying expensive, we should be selling to him at those expensive prices. Similarly, the key mistakes which the novices they make, the selling mistakes. Mistake number one, they always sell after a decline in price, right? The reason is technical analysis, fundamental analysis, and the emotion of fear. And the second mistake, they're not just selling anywhere on the chart now. Now they're also selling in an area where the chart has proven to us that back in history, demand exceeded supply. And now when somebody is selling at those cheaper prices, we should always be buying from them, because that is this novice seller who's making that novice mistake. So that is what our action is. Our action is, when somebody is selling at that cheap price, because we are anticipating that the prices would rise from this demand area, our action would be to buy from that novice seller who is selling at cheaper prices. If the prices they move up, yes, you entered that trade with a very, very small risk and you can make a lot of money on that. But in case it starts going against us, now we also know technically where we should be getting out with that small loss, right? Similarly, in a supply area, our action is, we wait for prices to come back to the zone, which is where we know the novices will be making that novice mistake, buying after a rally in price, buying in an area where the chart is telling us supply exceeds demand. And now when they are buying at those expensive prices, we are anticipating prices to decline. So we should be we should be selling to those novice buyers at those expensive prices. Now, as an example, this was that 70,000 phone, which is for 90,000 now. So they are happy buying at 90,000. We should sell to them at 90,000 because we are anticipating this move. If this move happens, yes, you make money. If this move does not happen, if it goes up, we know where our stop loss should be. We take that small little loss and then we are done with the trade. Right now, again, I'll add, just because you are learning or you are understanding this methodology does not mean all trades will always be winner, right? So this is something which I can guarantee you, that there is no such strategy in the world which will help you have winners on each and every trade, right? You will be having your your mix of winners, you will have your mix of losers, but the key criteria when we plan our trades is always reward to risk ratio, right? Which means, how much am I risking and how much can I make from that trade? So if your reward to risk ratios are good, you can be wrong maybe even 50% of the times and still you can be a profitable trader. And that is the advantage which you get using this methodology, because your risk is always very, very small compared to all other styles of analysis when it comes to most the conventional technical analysis. So now in summary, where are the market turning points? Price in any market turns at price level where demand and supply are out of balance. And now you know how that picture would look like on the chart, right? So that is just a brief example how it looks like. Now let me show you some trade examples from the past. Just give me a second. I'll bring up some trade examples for you. So let's start with the zinc. Right, so just give me a second, I'll bring that up. Right, so now this is an example of a trade which we planned on 16th of January, right? So this is your 16th. So this was the day when we planned this trade, right? So now, in fact, let me do this again for you. Let me show you as an example, right? So just give me a second. I'll bring that up for you. So just give me a second. So this is 16th of January. So I'm just trying to bring it up for you. Right. So can you see that's our website? So what we do is we share these trading ideas with our students well in advance. So this was that 16th of January. What I've done is I've zoomed out so that you don't see the numbers. In fact, let me zoom in only for 16th of Jan. Right. Let me do that for you. Right. So can you see this is your 16th of Jan, and can you see the trading idea for 16th of Jan was posted on 16th itself at around 5:20 p.m. right? So now if you look at 16th of Jan, what was the day? 16th of Jan was Tuesday, right? So can you see Tuesday after the markets they closed, right? 16th of Jan was Tuesday. After the markets they closed, we planned the trades for the session, that these are the trades we'll be looking today, which means this trade was planned in the future. That in the future, if we ever get this trade, can you see the trade was Hindustan Zinc? There you can see it. Our entry is 324.80, stop loss is 326.55, and this is your target one, which is 321.30, right? Can you see all the targets? The minimum we look for is 2:1. Now if you look at this, can you see this was the day on 16th we planned it, which means the prices were still here. And now if you talk about this, this is our picture of supply, right? So this kind of a pattern is called as a drop based drop. So we had this drop based drop. This is what we were looking as our supply area. And then see what happened. Prices, they started moving up. So this was 17th. On 17th, prices they started moving up. It didn't come to our zone. And on 18th, the very first candle came to our zone. So can you see after a rally in price, now somebody was buying at an expensive price, and somebody was buying at an expensive price where in the past the chart has proven to us supply exceeds demand, which means now this is a person who is making that novice mistake, buying after a rally in price, buying in an area where the chart is telling us supply exceeds demand. And if that person is buying at an expensive price, so what we should be doing is we should be selling to him, right? And now what we did was we sold to him. Screen is, oh sorry, my bad. Okay, my bad. So thank you for pointing that out. So what I'll do is I'll go back. Probably you were not able to see the screen. Let me bring that up again for you. So this is what I was showing you. And by the time it catches up, let me just read some of the questions which I have in the chat box. What is and how to use pivot points on charts? So now the fact is, we don't use pivot points. Now when it comes to pivot points, there are different kind of pivot points. One are the visual pivot points, which are basically the turn in prices, which are called as the pivots. The next ones are mathematically calculated pivot points, which is basically the previous day high, low, close. We add all three of them and divide it by 3, and then we again do some mathematical calculation to identify. So that high plus low plus close divided by 3 is basically your pivot point, and then we add some mathematical calculations to it, which helps us identify support 1, support 2, support 3, resistance 1, resistance 2, resistance 3. Now all those things we don't use, have no meaning for us, right? So I just gave you a brief, what it is all about, but again, in our methodology we never use it. So Nitin says, after signing up to this website at time logging in, it says invalid password on our website, sujitkakkar.com. That is where you're facing the challenge, right? Should not be, because maybe you made some mistake. Or what you can do is you can try to use the lost password option, right? In case it's not working, it will try to you will get the option to reset it. Otherwise, what you can do is just send an email to info@surjitkakkar.com with the login ID where you're facing this challenge, and we'll try to check and resolve the issue for you, right? Otherwise, you should not be facing this issue. So this is what I was telling you. Can you see this example? This was planned on Tuesday, and can you see this was posted on Tuesday itself at around 5:20 p.m. Indian Standard Time, right? So after the markets, they closed at 3:30. At around 5:20, we posted some of these trading ideas, and I'm just showing you one example, which is Hindustan Zinc. Now, if you look at Hindustan Zinc, this is what we planned. That was our supply zone, right? Please explain in a simple way. So, I'm trying to explain it the simplest way possible, right? That is how we started. But the problem is, this is a methodology which is very, very unique, right? Generally, if you look on the internet, not a lot of resources are available on demand and supply, right? So now how to do this is something you will have to learn. So unless and until you learn it, it will be a little bit complex. So the only way you can make it simplified for you is by learning the methodology, right? Now, again, that's the drop-based drop we were looking at. That was the supply zone for us. And can you see this is your 16th, right? On 16th, we were discussing this trade in the evening session. So the evening sessions are at 7 p.m. So 7 p.m. we discussed that if the prices, they come back, we can go short at this supply area. And see what happened. The next day, 17th, prices started moving up, right? And on 18th, early in the morning, the very first candle, we got our entry. So now the person who was buying after this rally in price, right? Mistake number 1, right? Could be the novice. Also buying in an area where the chart was telling us supply exceeds demand. So we were very happy selling to that person, and that is where you would have got your opportunity to go short, and that is where we sold. And after that, if you see, this is what happened. This was your 1:1, your 2:1. You got your target in about the very first candle. In fact, can you see the very first candle? You would have got your entry and your 2:1 as well. After that, you can see the script just has been going lower and lower and lower. Right now, the person who bought here, what he will be thinking is, why after I buy prices they decline? Because he doesn't understand, he was making that novice mistake. Now that person would say that technical analysis does not work, or maybe fundamental analysis do not work, right? But the thing is, they are designed backwards, so you need to know what is the correct way to do it. And this is where you should have sold and not bought. Just because prices are moving up does not mean we should be a buyer. Prices are moving up, they are getting expensive, it is much better to be a seller, and that is what we did. And you can see since then prices have been moving down. Let me show you another example. SRE Infra. So this was, I guess, a monthly income trade for us, for which I'll go to the daily chart. And here you can see this was again a supply zone which we planned. So this is the pattern which we were discussing in the examples, that we have a move to the upside, we have basing and came down, which we called as a rally base drop, right? So this was a rally based drop for us where we wanted to go short. So again, you can see after a lot of days, prices, they came back. Now the person who is buying here is again making that novice mistake. He's buying after a rally in price and buying in an area where the chart was telling us supply exceeds demand. So what we did, this was our shorting opportunity, and after that you can see prices they started moving down. Again, this person will be thinking that why only after I buy prices they go down, right? The reason is you're making that mistake over and over again. Now somebody was asking about a stock making all-time highs. Let me give you that example, HDFC Bank. And now this was again a trade which we planned long time back. Can you see, even at this point of time, the script was making all-time highs, right? And what we planned was, can you see here, we have a drop, base, again rally, and that is where we want to be a buyer on the script. And what happened, this was the day when we had that Gujarat election. In fact, I also posted this video for the HDFC Bank trade, and can you see, because of that election result, the markets were very, very volatile. Prices, they just came to the zone, touched it, and started moving up. And you can see ever since it just has been going higher and higher and higher, and we got our opportunity even to participate in this trade, right? But what are we doing? In all the trades, you saw that we are not buying when the prices are moving up. We are always buying when the prices are moving down. Prices came down, and that is the time we bought. And we are always selling when the prices are moving up, right? So we are not going against the logic. We are always in sync with that logic. We are always buying at cheaper prices, and we are always selling at expensive prices. Now that being said, it is not just about you just identify a demand zone and you buy, and you just identify a supply zone and you sell, right? So once you learn this methodology, you will see that it has much more to it. And what do I mean by it has much more to it? That we will be having not just one time frame, we will be having 3 different time frames which we will be looking into to understand the overall picture, which will help us understand, should we be buying, should we be selling. Plus, just because we have identified a demand zone, or just because we have identified a supply zone, does not mean we can trade it, right? We'll also be having some mechanical rules using which we rate that zone. Now in our methodology, what we do is, what you would have seen if you have seen demand and supply methodologies, even other people who teach that, what they do is they look at the quality of the zone, and based on the quality, they say, okay, it is a good quality zone, let me be a buyer. It is a bad quality zone, let me not trade it, right? But what we have done is, our methodology is much more fine-tuned. What we have done is, we score our zones on 2 different ways. One is the quality and the other one is probability. So we have mechanical rules to check the quality, we have mechanical rules to check the probability. So only when the zone is high quality and high probability, we trade those zones. If the zone is high quality but the probability is less, we don't trade it. Many times what can happen is, the quality of the zone can be a little bit low, but the probability can be high, right? So we make a mix and match to understand the complete picture, how the probability is stacked, how the quality is stacked, plus the multiple time frame analysis. And these are like small little pieces of puzzle which we put together to see the overall picture. And once we know that overall picture, that is when we decide which zones to trade and which zones not to trade. right? So that is what is that a small little overview of demand and supply methodology for you all, right? I just wanted to show you as an example. And I thought, again, these tools which we are using, which are helping us identify our areas of demand and supply, we call them as one of the tool is boring candle and the other one is explosive move. These tools are available for free. Anyone who wants to use these tools, you can use TradingView. You can go to this website, tradingview.com, and you can use these tools for absolutely free. No, you don't have to pay anything for it, and it will remain free forever. It's just that you need to know how to utilize it. So like somebody said, you're already an OTA student, which means you have learned demand and supply from OTA. You can also use these tools. These are available for you. And again, if you don't know how to use it, then probably you'll have to learn it. But otherwise, we have already designed it for you and available to all of you. So how to relate these supply zone and charts? So what do you mean by relate? You mean how to identify them? Like I said, to learn how to identify them, you will have to learn the complete methodology, and only then you will be able to identify those demand areas and supply areas. Why supply and demand zones not mark high or low areas? So I am not able to get your point. Probably, sort of, do you mean why have I not drawn the curve to understand where we are located on the curve, right? So again, because I told you we do something which is multiple time frame analysis. When we do our analysis, we do everything. It's just that I'm just showing you some examples where it was not required for me to mark the curve. I was just showing you the zones which we planned. In fact, let me just do this. Let me show you as an example. I'll zoom out a little bit and then I'll again resume my screen sharing. Right, so can you see, this is what I was telling you, that we plan our trades well in advance. Just give me a second. Now the next session which we will be having will be on Sunday, which is on 28th. So can you see, for the 28th session, we have already shared the trading ideas with the students, that these are the trading ideas. Oops, just a minute. Right, so now you should be able to see it. So can you see, we have already shared those trading ideas with the student, that these are the trading ideas we will be looking into on 28th of January, which will be the Sunday session. And now these trades will only happen on Monday. So can you see, using demand and supply, we can also plan our trades well in advance. What happens in other methodologies, you have to be in front of the computer, where unless and until you get those buy signals and sell signals, you can't participate. But here what happens is, you can plan your trades well in advance, and all you need to do is just have patience, wait for prices to come back, and if the trade still is qualified based on your rules, we simply go ahead and take that trade. Learn trading from you, and you taught me well at the online trading academy. All right, thank you, Ragini, for that. Good to know that things are working well for you. Great. So that was a small little overview, and the thing is, now we are getting close to 11 o'clock, and I have another session which I have to take at 11, right? So I can't extend this session. So in case you have any questions, queries, you can always email us at info@surjitkakkar.com. And if you're watching this as a recorded session, if you have any questions, queries, you can also put it in the comment box. Feel free to do that. Make sure you like this video, you share this video with your friends, your family, right? And also subscribe to our channel so that you keep getting updates whenever we are doing some sessions or we have some videos getting uploaded. You get updates for it. So okay, so Nitin says, sir, create Telegram group and post your charts. We do have a Telegram group, and that Telegram group is only for our students, right? So we already have a Telegram group which is only available to our students, and that is how it is. The reason is because we don't want to be a tip giving service. We want to be an education giving service. So that is what our main focus is, right? So we do have that as well. So once you are enrolled as a student with us, which is our POS Plus course, you also get access to that Telegram group. So thank you so much for joining in. Like I said, I have a session which is just starting in a few minutes. I'll have to rush. So thank you so much for joining in. Enjoy your extended weekend, and take care. Bye-bye.